All right. I told you that this one, okay, is a very interesting example about company's investor relations event, quarterly earnings announcement event, right? And as it turns out, because of the quarantine situation, they are all of these guys are doing in WebEx way, maybe Zoom conference kind of things, right? And still they're doing it in a video ways. Maybe because this is Netflix, okay? It's company's identity. This is about the videos, right? So why don't we show it to the video, okay? And here comes Michael Morris. I told you, right? Who is it? He's a equity analyst, star analyst at Guggenheim, right? Guggenheim, what is that? If you watch the what's that? The Titanic, the movie, there you see a Guggenheim family going, when the boat sinks, this guy, like, one of the richest family in America, right? He did not choose to, I mean, he chose to, go down together with the boat instead of looking for a chance to survive, okay? Because the people are so much in trouble, so he'd rather, kill himself, right? Die together honorably. Anyway, so Guggenheim family is there, and then Guggenheim, they have a securities house, investment bank, and then their equity research analyst, Michael Morris, is here. And by the way, for this one, okay, he is an industry expert in this media, okay, media industry, video especially, I guess. So he was invited over here so that he would be addressing those questions. Why I highlight this guy to you? Because first of all, learn about his attitude, about speech, and that his way of addressing questions. What kind of question does he ask, and then how does the CEO respond, okay, or the managers respond, right? Number two, he's a media expert. Korea, until now, okay, from Korea's perspective, we have been focused much more on semiconductor manufacturing, okay, Republic of Semiconductor. That's Korea. But going into the future, media is our next industry. BTS or entertainment companies, right? All these kind of things. CJ Entertainment kind of things, right? This is taking over the semiconductor industry going into the future. So learn about him and what kind of questions are important. You can pretty much benefit from this the videos, right? And number three, the way of speaking, right? Learn about his body language, all these kind of things, very important.
And take this opportunity to extend my best wishes to our viewers.
Right.
If there's, strategic long-term implications, because, we've just been scrambling to keep our service running well, keep the content, get our post-production done. Keep people connected, some people around the world who are incredibly lonely, connected through storytelling on Netflix. Certainly a distraction and certainly a big source of entertainment of yours. Of mine for you relative to where we were this time last quarter.
Yeah,
I think I'd echo what here to streaming on-demand entertainment is consistent. So there may be some timing impacts here, but overall that long-term trend is really unchanged. So what we're really trying to do is, as Ted and others said, is trying to make something that looks relatively easy and smooth operating, but in reality is a really hard work for a lot of folks, thousands of employees, and a lot of challenges throughout our company that we're doing our best to do that well for our members. Conclusion that I'd be
a pull forward of the rest of the year. So our guess is
there's some sensitivity there. And I guess my question is, when you think about pricing and pricing levers and packages.
So that's that. Go ahead and watch it. It's just about less than 1 hour. Instead of watching Netflix movie itself, watch their earnings conference call this quarter, right? And then, growth of subscribers. You'll have to think about this subscription base, right? Why is that the case? He talks about it, right? Top line is related. Top line of income statement, right? It's about the sales figure, right? So you have to pay attention to those. And then profitability, okay? You'll have to think about the margins and all these kind of things because it's giving you the cash flows, right? And then not only the top lines, right, but also the margins matter. And then remember Michael Morris, right? He is doing television interviews sometimes about this company, okay, in CNBC. Oh, yeah, familiar face, right, already. And then let's see if we can, yeah, go ahead and watch it, right? And then you will be able to see what kind of
If you or your business need help getting to the next
what kind of questions are being addressed in this media setting, in this television, and then how does the analyst work, right? About Netflix trajectory is very strong and will continue, right? Trajectory is very strong, he says. Okay, it's experts' opinion. Experts' opinion. That's it. And then to do FCFF, we need some prior work before we delve into FCFF estimation. What is that? Weighted average cost of capital, because this is the discount rate that we are going to use in this framework. And then for this part, we first set our investment horizon. Okay, how long are we going to invest? Well, let's say 5 years, right? Don't ask me why, right? RF, the risk-free rate, well, this is, I'm going to value in US dollar terms, so US risk-free rate, treasury rate, 5 years will be it. So that's 0.3%. In investing.com, I could find it. And beta is just a regression beta. I'm going to use it. Why is that? We are using regression beta because the company did not announce any plan to change capital structure or business mix yet. Okay, seems like their current business is doing okay, and then they're just keep on pushing. Capital structure or business structure doesn't change. Beta should be similar. Okay, RM minus RF, which is risk premium, equity risk premium. Let's just use historical premium of 5 percentage point. Okay, you can use other the implied premium depending on your choice, right? Or depending on you learned about this before, but I'm going to use 5 percentage point. So based on this, I can use CAPM. So if you do the math, you will realize the cost of equity to be 5.05%. And then share price right now in the market, okay, is $438.12. And number of shares outstanding, 438.807 million shares outstanding. So multiply these two, you get market cap or market value of equity of 192 billion US dollars. I mean, the students get awfully confused in Korea. Million, billion, trillion. So 100만, 10억, 조. Why not 100만, 1000만, kind of? Because the comma system is every 3 zeros you comma, and then your unit of calling it changes. 1,000, million, billion, trillion, zillion. In Korea or Asia, every 4 zeros you set comma kind of things, or the unit changes. 1만, 억, 조, 경, 해, 양, blah blah blah, right? So there is some kind of discrepancy, so it confuses you. But just please bear with me. Make it your habit over here. Million and billion. So 192 billion US dollars. Okay, and then with this, I could compute the weight of equity if I have some good information about market value of debt. Remember, this guy, market value, the weight of equity should be market value of equity divided by equity plus debt. I have this number 0.92. That means I already have some good information about the debt, market value of debt, but I'm going to show you in the next slide over here. So debt value, well, because it is almost impossible to observe the market price of debt, okay? It's not transacted frequently. It's just bank debt sitting on the balance sheet. 깔고 앉아. Right? So let's just assume their book value of debt as market value of debt, as the same as market value of debt. Okay? That's our one assumption we impose to simplify our life. Okay? In this semester, in this class, we're going to do that. Right? Now, for debt, we have two components, short-term debt and long-term debt. And add these together, you get market value of debt, 16.3 billion US dollars. So, together with this information before market cap, you can compute the weight of debt and equity. Okay, the weight of the debt and equity based on this and 190 billion dollars, right? So that's weight of debt to be 0.08 or 8%. Now, cost of debt is important, and we are trying to get to cost of debt is important. Okay, cost of debt. But for that part, you can Google search essentially. Bond rating of Netflix. They issued corporate bond before. So what is their current bond rating? Okay, Moody's assigned Ba3, which is like double B kind of junk bond status. Okay, it's risky companies, so their bond is not an investment grade, not high grade, but low grade or junk bond grade. Okay, so as long as you have this bond rating, you can obtain the default spread that you can assign. Okay. So I got 3.03 percentage point of default spread. Where did I get that? Well, in lecture note 6, I gave you the default spread, most recent one, by ratings category and by the maturity. I said 5 years maturity, and then the Ba3 rating is over here. That's Moody's rating Ba3. If it were assigned by S&P, it must have been about BB minus, which is this guy, 3.03 percentage point, right? So that's how we obtain this guy. Now, what do we do? With this, you have to add risk-free rate, okay? Risk-free rate plus this guy. And then the risk-free rate is 5-year US Treasury rate, which was 0.3 percentage point or something. Is that right? Let me check. All right. 0.3 percentage point. Yes. So adding this, you will get cost of debt to be what? Well, rounding error, 3.33%. 333, right? All three, right? Triple threes. So don't worry. I mean, this is, if you increase it, you will see 3.33 coming up. And tax rate, marginal tax rate, well, let's assume it to be 35%. That's over here, okay? Of course, recent marginal tax rate by Donald Trump must be like, what, 0% or something? Or 20% maximum, okay, 20%. I could have done that, right? But 35% is just usually, conventionally, it has been there. So I just threw it in, okay, by habit. But you have to be more precise later. Anyway, so with this information, I can obtain the weighted average cost of capital. All right, so weighted average cost of capital. So if you do the math, you will find out that this is 4.82%. So again, weight of equity times cost of equity plus, this is times, right? 1 minus tax rate times weight of debt times cost of debt, right? So that's WACC. You will find it out, right? Good. expected EBIT growth rate. Since we are using FCFF, we need to have a good idea about growth trajectory and the expectation. EBIT growth, right? EBIT growth. We watched the sales growth before. How about EBIT growth? Is it growing together with it? Okay, is a question that I'm trying to address over here. And you see red line is net income, and then blue line is EBIT, right? So it seems like it's in a exponential growth trajectory as well. It's in a high growth stage. Historical EBIT growth rate, almost exponential growth, still growing very fast. I remember Guggenheim's analyst is saying, right, it's still growing fast. So in 2019, EBIT grew like 62 percentage point. And then 2014 to 2019, the average growth rate was 54.92 percentage point. And then geometric growth rate. Okay, my dog is barking again. Okay. Wait. Right. Geometric growth rate from 2000 to 2019. Well, it is 49 percentage point. Okay, 49 percentage point. How do we get that 49 percentage point? Well, this is your ending EBIT, and that is your beginning EBIT of 2000, right? And then there must have been some exponential growth rate over this 15-year period. Was it 15? 4.472. Oh, it's not 2000. I'm sorry. This has to be 2004. It's the EBIT when the EBIT was positive for the first time. Okay, so if I bring you to previous picture over here, the EBIT started to be positive 15 years ago, from here to there. Okay, so that's 2004. Before it was like a negative number over there. So starting from negative to positive, you cannot estimate the growth rate. Okay, here's a limitation about the data. It's anyway in our estimation. Many things are based upon the assumption that it is positive number in the first place. Negative number, we have to drop it somehow. Here started to be positive, starting from here, 15 years period, ending number over here. All right, so that's what's going on in this calculation. You solve for G. Okay, G should be equal to this guy divided by that. Nah, I should shut my mouth, but raise it to the power of 1 over 15th, and then minus 1, because we started with 1 plus growth rate. Okay, so 1 minus. That's about 50 percentage points. So I'm going to get back.